So you're caught up in this situation. What demand should you trade, and why? It's what we will talk in this video, so let's jump straight into it. Now, if you've been watching my channel, you probably know what we should be doing for the first step. If you're new here, we will explain anyway, so don't worry. When you get into the charts, the first thing we do is a directional analysis of the price action, which is exactly what is it called? An analysis of the direction the price had recently. You can do that just by looking at the swing points, but what I usually do to make it easier to see is that we draw the price action with arrows and lines. And you will notice a similar pattern on the swing points. The highs were always lower than the previous highs, meaning that we've got lower highs, while the lows were always lower than the previous lows, meaning that we've got lower lows. When these two are coupled together, meaning that, for example, if a lower high is then followed with a lower low, that's a downtrend pattern, because both of the swing points are swing points that happen during downtrends. So if the trend is clear and simple to understand, then it's easy to know what you should be doing. On downtrends straight and forward, we look for supply levels, resistance levels, and so on. So basically, we look for opportunities to sell the market. The problem comes when eventually one swing point should reverse. For example, in this case, the market pushed to the upside, still ended with a lower high, but then it pulled back with a downside movement, and this ends higher than the previous low. So this is not a lower low, but this is a higher low. Now, on the last two swing points that we analyzed, we had a lower high, which is a swing point of a downtrend, but then we have a higher low, which is a swing point of an uptrend. So before we had downtrend swing points, now we're starting to have the first uptrend swing point, which obviously is a big signal the market should see a reversal pretty soon, just like it also did, because from that first higher low, the price goes higher and higher until it eventually breaks above the previous lower high. So if the lower high broke to the upside, that means that we now got a new higher high. A higher high is a swing point of an uptrend, which is coupled with the higher low, also being an uptrend swing point. When this happens, the trend changes from the previous one, being a downtrend, into a current one, being an uptrend. Now, when the trend changes into an uptrend, the plan for sell setups also changes. We no longer look for sell structures like supply and resistance levels, since it's too risky and honestly doesn't make sense to sell a market that it's increasingly getting more and more pressure from buyers. So, if selling doesn't make sense anymore, then buying might start to make some sense. We just need to look for opportunities. On uptrends, we plan buy setups from demand and support levels. They are found on the last downside movement before the market started to push to the upside. So, until now, things were simple, but now it starts to get more complicated. So you see that this demand got filled, the price hitting it, and then bouncing to the upside and breaking above the last high. So it respected. And you might think that this movement also left a demand, because the price pushed down and then started an impulse to the upside. And as you know from the theory, a downside movement that is then followed with an upside impulse usually will leave a demand from the last low. So there might be another demand right here. I changed the colors so we can differentiate them. Right. So we have two demand levels. So basically two levels from where the market might bounce to the upside after hitting them. So the question becomes, which one will respect? Well, the most realistic answer is that we can't know for certainty. We can just assume based on what level might be higher quality, and that's exactly our goal, finding which one is of higher quality. There's two ways of doing so. One is a more complex way of thinking, and one of more simple, but with a good logic behind it. On the complex way of thinking, if we come back to where the first demand is filled, the thing is that if you were at this exact point without seeing what happened soon after, then you couldn't really say that this demand was valid, because we don't have any validated bullish swing point, and the price might as well just drop down from here. What I'm saying is that this first demand, the purple one, validated only after we've seen that the price broke above the last high. It's only after we got the higher high when we knew this market has a high chance of reversing into an uptrend. This makes a huge difference, because if you have that in mind, then that means that this wasn't actually a valid fill of this demand. So this means that it might still work in the future, so we can't invalidate it. Now, on the simpler way of thinking, you always choose the demand that's the lowest, because that's the one with the smallest risk. Because what's more important is the placement of the stop loss. If you trade the upper demand, then the stop loss would be placed below the first demand. But in this case, if the market drops down and fills the lower demand, you get stopped out. And if we trade the lower demand with the stop loss being placed below the demand, so if the market would fill and bounce from the lower demand, the stop loss won't get hit. On another scenario, the market just wants to enter into a downtrend and so it breaks down and starts forming lower lows on the swing levels. In this scenario, no matter which demand we trade, we get stopped out. But so far, we don't have any sign of this market turning into a downtrend, so this last scenario of both demands breaking down is the least likely to happen. Now keep that in mind. It's about probabilities, not about certainty. Now we wait and see what happens. It's slowly pulling back down, and it instantly breaks through the first demand, so it actually filled both of these demand levels, the first one right here and the second one here. But if we would have traded the upper demand, the stop loss would get hit. The lower demand also filled right here, and if the stop loss is being placed below the demand, we see that the stop loss didn't hit yet, but it's also not won yet. Now for the take profit, logically should be above the high, but in such a way to get a decent 1-to-2 ratio or slightly higher, we see that the price is approaching those higher levels that eventually break above and closes on the take profit. Now let's see on another market. If we analyze the price action, we will notice that it initially was following a downtrend pattern of lower highs with lower low swing points. So of course, during this type of price action, we don't look for buy setups, because selling might make more sense. And if you don't want to sell, then we just stay away from any position until the market reverses its trend, just like it did. Because we see that from the lowest point, the price started gaining bullish pressure, and this eventually broke above the last high, even above all of the previous highs. But the break above the first high is the most important one, because that's what signals the beginning of the trend change into an uptrend. That's because we finally went from forming lower highs into now having the first higher high. The higher high being an uptrend swing point, and a higher high should be followed with a higher low. These higher lows will often fall down to fill a demand or support level that's found on the lower levels. And so we identify a demand or support on the lows, which should be around this level. Now if we analyze what the price action is doing right now is that from this higher high, we got a downside pullback which later was followed with another upside push. This upside push breaks above the last high. So we have two new swing points, a higher low and a higher high. Now if you apply the theory that says that a demand is found on the last low before the market started the upside impulse, that would mean that we identify another demand from the last low, which would be around this level. Now again, we have patience for the price action to do its thing. Now here it's quite interesting. Let's take a look at what happened. So from this high, the market has again pulled and then pushed to the upside, leaving another higher low with higher high formation. So this would form another demand from the last low. So you can see why taking the lowest demand is often the decision with the least risk. Because for example, from the high we have a massive downside impulse, and this downside impulse breaks below the upper demand, which was the most recent. It also breaks down below the middle demand, which was the second one. So if we would have placed a buy setup from the upper demand, it would have ended in a huge loss being hit. Also, if we would have bought the middle demand, the same story would happen, losing on the stop loss being hit. And out of 3 demands, if 2 are invalid, that means that there's only one left, which was the first demand, also being the lowest available. Now we can't see what happened from this demand because the price didn't even hit it yet, but we can try right now to plan a buy setup on the demand. The stop loss below it, exactly with the same logic as we had on the last ones. For the take profit, on this channel I usually tell my viewers to aim for 1-to-2 ratio, or slightly more, but in most cases, you probably shouldn't target for more than 1-to-3. We got the market pulling back down. It hits into the demand, which opens the buy position, and it quickly bounces to the upside, holding bullish pressure until it eventually hits the take profit target. Now we see that it even went higher than that, approaching this swing high, and it will probably even break above it. So yes, you could have probably get a way higher ratio and a better take profit. But the problem is that this thing will happen 1 time, maybe 2 times, and then you will lose most of the setups, eventually even losing back all the profits that you've made from the winning setups. So don't greed it too much and keep a sustainable risk reward. You can also look it up on the link in the description where that's exactly what we're focusing on, because winning trades is not hard. What's actually hard is not losing them back.